Austria has 9 million people, smaller than New York City. Yet as of 2006, its banking sector had accumulated foreign assets in Central and Eastern Europe equivalent to nearly 70% of the entire Austrian GDP. But almost no one outside the world of finance has ever heard this story. On November 9, 1989, the Berlin Wall fell, and with it, an entire economic order. Overnight, nearly 400 million people in Central and Eastern Europe were thrust into capitalism with no functioning banks, no credit markets, and no financial infrastructure. It was a vacuum. And Austria, sitting directly on the border, was perfectly positioned to fill it. Through the 1990s, Austria's two banking giants Erste Group and Raiffeisen Bank International launched one of the most aggressive financial expansions in European history. They acquired state-owned banks at deeply discounted prices in Hungary, Czech Republic, Slovakia, Romania, Croatia, and Serbia. By 2000, Raiffeisen Bank International alone operated in over 10 Eastern European markets. The strategy was simple but brilliant. These countries desperately needed modern banking systems. Austrian banks brought capital, expertise, and Western credibility, and in return, they captured dominant market positions before any serious competition arrived. By the mid-2000s, Erste Group had become the largest retail bank in Czech Republic and one of the top three in Romania and Hungary. By 2008, Austrian banks collectively held over 200 billion euros in assets across Central and Eastern Europe. In some smaller markets like Croatia and Slovakia, Austrian-owned institutions control between 30 and 50% of total banking assets. The IMF formally noted that Austria's financial exposure to the region was among the highest of any country in the world, relative to its own economic size. Then came 2008. As the global financial crisis erupted, Austria suddenly found itself dangerously exposed. Eastern European currencies crashed, loan defaults surged, and international investors began asking a terrifying question: if Eastern Europe collapses, does Austria collapse with it? The IMF and European Commission launched emergency talks to stabilize the region, specifically to protect Austria's financial system. Austria survived, but just barely. The so-called Vienna Initiative of 2009 brought together governments and banks in a coordinated pledge not to withdraw capital from Eastern European subsidiaries, preventing a catastrophic bank run. It was a remarkable moment. A small country's outsized ambition had created a financial system so deeply entangled with an entire continent that its failure was simply not an option. Today, Erste Group and Raiffeisen Bank International remain among the most systemically important financial institutions in Central and Eastern Europe. Austria, a landlocked nation with no ports, no colonies, and no natural resources, turned geography and timing into a financial empire that shapes the daily economic lives of over 100 million people. Sometimes the most powerful empires are the ones nobody talks about.